Good afternoon. My name is Jeffrey Silver. I'm a partner in the Integrated Services Department, and welcome to Isdaner Company's webinar on tax credits and incentives. We have a great presentation today. We're going to talk about some new credits that are available and some extensions of some old credits and new things that are involved in the general credit area. We have a series of panelists that will provide information on different types of credits that are available to you now. A couple of housekeeping items. The first is we do have a Q&A box that's available to you. So if you would like to send in a question, please do so and make sure that your name is on there. In the event that we don't have time at the end to get to all the questions, then at least we have your name and your question and we'll respond to you as soon as we can. There's also the availability to email directly to the presenter or to anyone else, and we'd be happy to get back to you as soon as we can. The presentation is being videotaped, and so it'll be available on our website and also our YouTube channel, and our slides are going to be available if you're looking for them. And so to start with today's presentation, next slide, please. The first item we're going to talk about today is the Inflation Reduction Act and its tax credits. This was signed into law in the summertime in late August. There's a series of new spending and tax breaks that are available to us. The act is designed to boost domestic clean energy production, as well as reduce healthcare costs and fund the IRS. In order to pay for it, there's also added a 15% minimum corporate tax that is intended to offset the spending measures that we're going to talk about under the IRA. Again, there's some new and revised tax incentives, and most of them are for clean energy projects. Next slide, please. The credits are available to businesses and consumers. There are tax credits for the energy production and investment in wind, solar, and geothermal energies. There's also credits available for nuclear energy, hydrogen energy, and things of that nature. We're going to talk about more of residential and personal use credits, which are really under clean energy costs for things like new solar panels, geothermal heating, and things of that nature, as well as the expansion of the electric vehicle tax credits, and also residential home credits. Next slide, please. So as far as the clean vehicle credits are concerned, the IRA extended this type of credit through the end of 2023. Effective next year, January 1st of next year, the IRA has included not only new electric vehicles, but also previously owned vehicles, as well as commercial clean vehicles, such as buses, fire engines, and things of that nature. What the IRA did add to its requirement is that the final assembly of these vehicles must be done in North America. Prior to this, it was not required, but it is now under the new IRA Act. What it also does is it removes the manufacturer sales caps beginning of next year. There used to be approximately 200,000 vehicle cap for any particular manufacturer. That no longer exists. And also, starting in 2024, you can use your credit to reduce the sale price of the item, or you can also sell it to an outside party. Next slide, please. Regarding the electric vehicles, the credit has always been maximum 7,500. And so that's going to continue until 2032. And that's for vehicles with gross weight under 14,000 pounds. There's also for commercial vehicles, $40,000 credit for vehicles over 14,000 pounds, which again would be things like buses, fire engines, and things of that nature. And then for used electric vehicles, you're allowed a credit for the lesser of 30% of the price or 4,000, whichever is less. Next slide, please. The one thing the IRA did add to this, besides some of the things that we mentioned, was that the manufacturer's suggested retail price has to be below certain thresholds, and you can see them here. For passenger vehicles, the 80,000 would be the maximum price. For new vehicles, it would be 55,000 would be the maximum sales price, and then for previously owned electric vehicles, it's now 25,000. And so those are the maximum amount that would be available in order to get the credit. Next slide, please. This is also new, in that there are AGI limitations on availability of the credit. And so you can see the numbers here. It has reduced the availability to higher income taxpayers. There's still a $300,000 limit for married filing joint, but it is limiting now to the AGI. Next slide, please. There are some additional resources here that you could use in order to get some additional information. Feel free to use those for things like the VIN number and what models might apply to the new regulations. Next slide, please. Besides the clean energy credits, there's also an expansion of the home energy improvement credits through 2023. I'm sorry, 2032. Starting in 2023, the credit's 30% of the cost of eligible home improvements. And it used to be where you had a $500 lifetime limitation on certain products, but now it's been replaced with a $1,200 annual limit. And things that apply in this arena would be $150 credit for home energy audits, $250 maximum credit for an exterior door, up to $500 total for all exterior doors, as long as they meet the applicable Energy Star requirements. $600 for exterior windows, again, as long as it meets the Energy Star efficiency requirements, and $600 for things like central air, water heaters, and things of that nature. Next item, next slide, please. There's also the residential clean energy credit. And this is a credit of 30% for next year to 2023 for things like solar paneling and geothermal energy. That was in place prior to this act, but it's been extended. And as you see, as time goes on out to 2033 and 2034, the 30% goes down to 26 and 22%. Next slide, please. And the last part of this part of the presentation is going into next year. The credits are available to be either used as a rebate when you purchase an item, or the credits can be transferred to other tax-paying entities. So, as an example, when a city, for example, wants to buy a fleet of clean energy buses, then they could either and both use the available credit for up to 40,000 as a rebate against the purchase price, or they could also sell any of these credits, because as you know, the tax exempt entities don't really have a tax liability, so the credits wouldn't offset their liability. But these credits can now be sold to third parties that are looking for ways to reduce their own tax costs. And areas in which this is eligible at the bottom of the slide here is things like renewable electricity production, clean electricity investment, as well as the commercial vehicles that I mentioned. The next series would be presented by Amy Stumhofer.
Thanks, Jeff. The three credits that I'm going to talk about are not new, but they may be things that your business is already doing or thinking about doing, and you may not have known that there was a credit available for it. The first one is the Disabled Access Credit. This is a credit for small businesses that incur expenses for the purpose of providing access to people with disabilities. Eligible businesses need to have gross receipts of $1 million or less and no more than 30 full-time employees. Eligible expenses are those paid to comply with requirements under the Americans with Disabilities Act of 1990. It could be expenses to remove barriers that prevent accessibility, like a wheelchair ramp, accessible bathrooms, or it could be expenses to provide interpreters or audio materials for the hearing impaired. It could be expenses to provide readers or visual materials for individuals with visual impairments, or it could be expenses to acquire or modify equipment or devices for individuals with disabilities. The expenses are not eligible if they are incurred in connection with a facility first being placed into service. So if you're building a new building, the fact that you're adding a handicap ramp or accessible bathroom won't qualify. It has to be an existing building that you're modifying to comply with the ADA. The credit amount is 50% of eligible expenses up to a $5,000 credit. Next slide, please. The second credit that I'm going to talk about is the small employer pension plan credit. And this credit is available for small businesses who set up a retirement plan for their employees. An employer is eligible if they have 100 or less employees who received at least $5,000 in compensation in the last year. And they have to have at least one participant who is not highly compensated. In the last 3 years prior to the first year of the plan, you could not have sponsored another plan either in this entity or in a related entity. Eligible employers can claim a credit between $500 and $5,000, depending on the number of employees, for the costs of starting a SEP, a simple or a qualified plan like a 401k. Eligible costs are costs to set up and administer the plan and costs to educate the employees about the plan. The credit can be claimed for each of the first 3 years, and you may start claiming the credit in the year prior to the plan being effective. If you add an auto enrollment feature to the plan, you can claim an additional $500 per year for the first 3 years. Next slide. The third credit is the Small Business Health Care Tax Credit. This is a really sort of narrow credit that's only eligible for very small employers who offer a health insurance plan to their employees. The employer can be a small business or a nonprofit. Employers are eligible if they offer a health plan through the SHOP marketplace. That's the Small Business Health Options Program marketplace, and it can be done online. You have to have less than 25 full-time equivalent employees, and actually it's phased out between 10 and 25 employees. So the more, the closer to 25 employees you get, the less of a credit you're going to get. And you have to pay wages, average wages of less than $56,000 per year per full-time employee. So again, it's only for very small employers who don't have highly compensated employees. And you have to pay at least 50% of the cost of employee-only health insurance for each employee. The credit is 50% of the premiums paid for small business employers and 35% for tax-exempt employers. And it does not include any credit for health insurance paid to owners or their families. And next, Cindy is going to talk about some small business or some additional business credits.
Thank you, Amy. First, I'm going to talk about a couple of Pennsylvania tax credits. They are the Educational Improvement Tax Credit Program and the Opportunity Scholarship Credit Program, also known as the EITC and OSTC programs. Next, please. These programs are administered by the Department of Community and Economic Development, also known as the DCED. These credits are given to businesses that make contributions to qualified educational organizations, and those organizations fall into 3 different categories. They can be educational improvement organizations, scholarship organizations, or pre-K scholarship organizations. Or on the OSTC side, credits are given for contributions that are made to scholarship organizations that benefit students that reside in underperforming school districts by providing scholarships to these students to go to other public or private schools. There's a list of organizations that qualify under these categories on the DCED website, which you can find in the slides. And there's hundreds of organizations. Next, please. The credit amounts are substantial. You can receive up to 75% tax credit for every dollar spent if you make a one-year commitment to these organizations, or 90% tax credit up to 2 years. And you can apply for up to $750,000 in credits. These 75, 90% credits are given for EITC scholarship organization contributions, educational improvement organization contributions, and opportunity scholarship organizations. 100% of the first $10,000 that you contribute to pre-K scholarship organizations are awarded under that category, and then you get 90% credit for the remaining amount that you would contribute, up to a maximum of $200,000 per year. And the pre-K scholarship organization, you don't have to make a 2-year commitment. That's on a year-by-year basis. Next, please. These benefits, these tax credits can be applied against many PA taxes. There's probably about a dozen. They're listed on DCED's website, but the ones that we see being applied against in our office usually is the corporate net income tax, the personal income tax for PA, and also bank shares tax. Businesses apply for these, but you can also form what's known as a special purpose entity. And the main reason for applying for these special purpose entities is just to try to apply for these credits and make contributions to organizations that you desire to contribute to and get these credits. And these entities can be made up of a husband and wife. It can be made up of, a few members of organizations that are interested in contributing, say, to the art museum educational program or ballet program, educational program, things like that. And we can facilitate in helping you do this, and also in getting these credits. When you consider both the federal and state tax benefits of applying for these credits and making these contributions, it actually, out of pocket for C Corps, could cost you as little as $10 or less out of pocket, and $630 if you're a pass-through entity and you're taking the credit on your personal return, assuming you're in a 37% marginal tax rate. These credits can be used against other income besides business income on your PA return. You can use it against wages, capital gains, interest, dividend, all the 8 categories on the Pennsylvania income tax return. Next, please. The application process is that you fill out and complete what's known as a single application on DCED's website. And you can see on the slides how you get to that. The applications for first-time applicants are open on July 1st or whatever business day falls after July 1st for new applicants, and May 15th for those return applicants. As I said, the maximums are $750 or $200 for the pre-K program. And on the application, if you apply to get into one of the EITC programs and you're not credited with that, you can roll that application over into the OSTC program. And as I said, it's a first come, first served by day basis. So, it doesn't matter what time you put in your application on July 1st, it's all random selection on that day. However, just to note that usually the money that's been allocated by the state for these programs is usually gone and done by July 1st. If you do get the credit, you have to also be in state tax compliance, meaning you have to have all your business or individual returns filed and the liabilities all cleaned up. You will be allowed to come into compliance by being notified, and then they give you a certain amount of time before they pass on your credits to somebody else. So they are willing to work with you. Next, please. After approval, if you get the credits, you get a letter. You have 60 days from the date on the letter to make the contribution, and 90 days from the date of the letter to get the acknowledgement that you did make the contribution from the organization back to the DCED. These credits can't be sold, assigned, or carried forward, but you can elect to pass them through on Form 1123. Credits can be used, as I said, against 100% of your liability, but they are not refundable credits. So, any questions or anything about how to do this? If you're interested and want to speak to me later about this, my contact information will be available. Next, please. Also, I'm going to talk to you about R&D tax credit. This has been around since 1981, and it was initially put forth to stimulate, of course, R&D in the US. What this credit is the dollar for dollar offset against your federal income tax liability or possibly payroll tax liability if you're a state startup company. It can also be used against AMT. Credit here is given for certain activities that are performed in order to develop, design, improve products, processes, formulas, or software. Also, many states, actually most states, have passed regulations allowing the R&D credit. And as you can see, there's a lot of industries that covers. There's no industry that's eliminated. So, it's a matter of if you qualify by what type of activities you're performing in your business. But as you can see, manufacturing, cannabis, software development, food, machinery, architecture, engineering, aerospace. So, it's unlimited. Next, please. What this credit would do is you would get roughly 12 to 16 cents on your dollar for every dollar you spend for R&D would be qualified for the credit. It's a dollar for dollar reduction of your federal liability and state income tax liability. This helps to improve your cash flow, increase your earnings per share, reduce your tax rate, and also this credit can be carried forward 20 years. You can also do what's called look back studies, meaning that you can go back 3 years, usually 3 years, and amend your returns for any unclaimed credits that might be available. And again, you can use these against your payroll tax liabilities if you're a startup. Next, please. As I said, it doesn't matter what business you're in, it matters what activities you are doing in your business that would qualify for the R&D credit. These activities have to be technological in nature, meaning they have to rely on principles of biological or physical science, engineering, computer science. They have to be for a permitted purpose, meaning they have to be performed in an attempt to improve something, whether it's its functionality, performance, quality, reliability, and it has to be either a new or existing business component. And that doesn't mean new to like everybody, it means new to your business. These activities have to eliminate uncertainty, meaning that the information that you discover should eliminate some uncertainties concerning development or improvement of a product or procedure, and it has to contain experimentation, meaning that somewhere you have to have activities that include testing, modeling, simulating, or trial and error. Next, please. What expenses can you include in order to calculate the credit? Well, you can include salaries that are paid to your people that are working in the R&D department or performing R&D activities, and also those that support R&D activities. All of your supplies and materials that you use to conduct the R&D activities. And also if you do contracted research activities that you contract to other companies or individuals to do the R&D for you, you can take up to a 65% credit if it's another business or individual, or if you're contracting with, say, a university or technical institute, you can take up to 100% of those expenses. These are claimed on Form 6765. There's a couple methods to calculate the credit, of which, we can help you with that. Next, please. Some of the changes, 2022, which there's been, organizations and whatnot that want the IRS to delay these changes, but right as of now, what happens in 2022, if you go to amend your return, you're going to be required to provide basically the R&D studies that are done for those years that you're doing the look back for. And that includes, listing out all the procedures, people, salaries, et cetera, whatever. But this is normally done as a process of the study anyway, so it's just a matter of attaching it to the returns. And this would include if you're passing on the R&D credits to the owners, shareholders, individuals, et cetera, they would also have to include this documentation. But like I said, there's been lobbying that they delay this until 2026. And just to let you know that Pennsylvania and New Jersey do allow R&D credits. They have their own forms and their calculations are a little different than federal, but as I said, we can help you with all this. And if you have any questions on any of these credits, feel free to contact me. And next, Ernest Mozer will let you know about other credits available.
Thank you, Cindy. Good afternoon, everyone. Ernest Mozer. I'm here to discuss the low-income housing tax credit. It's not a new credit under the Inflation Reduction Act, but it's an important credit that everyone should know about. The purpose of this credit is to provide a tax incentive to owners of affordable rental housing rather than providing loans. To be eligible, the credit can only be claimed for residential, rental buildings, and low-income housing projects. Only owners of residential low-income rental buildings are allowed a low-income housing credit for each qualified building, and this credit is annually over a 10-year period. A separate allocation and certification must be issued for each building in a multiple building project. The owner of the building must obtain a housing credit allocation from the State Housing Credit Agency, and certain information has to be certified. Once an allocation is made, the credit is allowable for all years during the 10-year credit period. Next slide, please. The credit, the Taxpayer Certainty and Disaster Tax Relief Act of 2020 set a new minimum applicable credit percentage rate of 4% for existing buildings placed in service after December 31st, 2020. The Housing Credit Agency is required to allocate only the amount necessary to make sure that the project is feasible. There are many definitions under this credit. The first one is the Housing Credit Agency. This is a state or local agency authorized to make low-income housing credit allocations within its own jurisdiction. The Building Identification Number, or the BIN. This is a number assigned and associated It's assigned by the Housing Credit Agency to a building and must be used for any allocation of the credit. Any improvements to the building should be used and should use the original bin first assigned to the building. The allocation of the credit is generally for a taxpayer to claim a low-income housing credit. The Housing Credit Agency must make an allocation of the credit by the close of the calendar year in which the building is placed in service. Next slide, please. There are many steps to calculate the credit, and there's many forms to be completed. The eligible basis is the total cost that is considered in using funds to calculate the credit. The applicable fraction and qualified basis is the percentage of property that is allocated to affordable housing, and the total cost basis that is eligible for credits based upon the applicable fraction. The applicable percentage is the appropriate tax credit rates with adjustments made for the applicable federal rate plus any additional credits. As I alluded to before, there's many forms. The first form that has to be completed is Form 8609, and that is the low income housing credit allocation and certification that must be presented to the State Housing Authority. Form 8609A is the annual statement for low income housing credit that has to be completed annually. And finally, the Form 8586, which is the actual low income housing credit calculation that is to be attached to your tax return. Next slide, please. Of course, with any big projects, there's much record keeping to be done. The following items are to be kept for 3 years after the due date, including extensions of the owner's tax return for the tax year that includes the end of the 15-year tax compliance period. You must keep a copy of the original Form 8609, any election statements that were filed with your tax return or with the State Housing Agency, any binding agreements specifying the housing credit dollar amount that was received, and any allocation agreements or documents that you entered into. Next slide, please. Pennsylvania also has a housing tax credit, and the purpose of Pennsylvania's credit is to encourage development. To be eligible, all projects that qualify for the federal low-income housing tax credit also qualifies for the Pennsylvania House Tax Credit. This credit is administered by the Pennsylvania Housing Finance Agency. The application is an annual process, and the reporting is done annually on or before October 1st of each year. Next slide, please. The second credit that I'd like to speak to you today about is the Historical Rehabilitation Tax Credit. This credit is available for amounts expended for the substantial rehabilitation of a building that is a certified historic structure. The building must be a certified historic structure listed individually in the National Register of Historic Places or located in a registered historic district and certified by the Secretary of the Interior as being of historic significance to the district. Taxpayers that own an interest in the building directly or through a pass-through entity, such as a partnership or an LLC, are eligible to claim the rehabilitation credit. Next slide, please. Substantial rehabilitation. This is any rehabilitation expenditure incurred during the 24-month measuring period selected by the taxpayer, where the expenditures exceed the greater of $3,000 or the adjusted basis of the building at the commencement of the 24-month period. Of course, there are exceptions. One exception is that the taxpayer can substitute a 60-month measuring period for the 24-month measuring period if certain requirements are met. The property has to be qualified. It must be a certified historic structure. The qualified rehabilitation expenditure is an amount which is chargeable to a capital account, which depreciation is allowed, and which is a non-residential real property, a residential real property which has a class life of more than 12 and a half years, or an addition or improvement to such property. There's also disqualified leases that can't be entered into. These are leases in excess of 20 years, leases with purchase options, and sell leaseback arrangements. The term placed in service means when the property is placed in a condition or state of readiness and availability for a specified assigned function. Next slide, please. The computation of the credit is 20% of the qualified rehabilitation expenditures with respect to the qualified rehabilitated building claimed ratably over a 5-year period, beginning in the year the qualified rehabilitation building is placed in service. There are tax-exempt use property rules that everyone should be made aware of. And that is proper use for used by tax-exempt entities, including governments, foreign entities. There is an exception to this rule if 50% or less of the property is leased to a tax-exempt entity, and also disqualified leases. There needs to be a basis adjustment to the property. The basis of the property must be reduced by the amount of the rehabilitation credit. The property is subject to the at-risk rules. Taxpayers are subject to this, and the rules limit any losses incurred by the taxpayer in connection with trades or businesses to the amount with respect to which the taxpayer is at risk. There are also passive activity loss rules that must be adhered to. If a building is used in a passive activity, the credit will generally be limited to the tax on the net passive income. And of course, there's recapture. If the property is disposed of or ceased to be an investment credit property during the 5-year credit period, there is recapture. Next slide, please. Our next presenter will be Carrie, and she will be presenting the Work Opportunity Tax Credit. Thank you for your participation today.
Thanks, Ernie. Work Opportunity Tax Credit, the who, what, when, and how. Next slide, please. What is this credit about? The Work Opportunity Tax Credit is for employers who hire employees falling into what are known as targeted groups. People in these groups have faced significant barriers to employment. For example, they have a criminal background or a disability. The program is federal, and it is run jointly with states through state workforce programs and agencies. It is currently set to end by 12/31/2025, meaning you must have hired your qualified employees by this date in order to receive the credit. One company you may know about that endorses this kind of hiring is Dave's Killer Bread. Dave Dahl, a convicted criminal, decided to turn his life around and created an organic, vegan, non-GMO bread. Today, this bread is the #1 organic bread in America. 1 in 3 of the more than 300 employee partners at the company's Milwaukee, Oregon bakery has a criminal background. Businesses that participate in hiring qualified Work Opportunity Tax Credit candidates can experience a competitive advantage, address labor shortages, while also creating a healthy, diverse work culture. Next slide, please. Who are the employees qualifying an employer to receive the credit? There are currently 10 targeted groups identified by the IRS as having faced significant barriers to employment. Some of the groups included are qualified veterans, employees with disabilities, residents from certain geographic communities. For example, an empowerment zone or a rural renewal county, In Pennsylvania, Philadelphia and Camden are both empowerment zones, and the counties of Warren and Venango, and these are near Lake Erie, are our rural renewal counties. The full list can be found on the IRS Work Opportunity Tax Credit webpage. Next slide, please. When do you get the credit and how much is it? The credit is generally up to $2,400 for each employee hired. The employer receives 25% of the employee's wages back in credit once they have worked 120 hours, up to a maximum of $2,400, and 40% once the employee has worked more than 400 hours, again, up to the maximum of $2,400. As well, there is a credit of up to $9,600 for certain qualified veteran employees. This credit for the veterans is good for the first 2 years after they are hired. The credit is available for every employee certified as being in a targeted group. It is only limited by the business's income tax liability or the nonprofit's Social Security tax. As well, employers can carry the current year's unused credit back 1 year and forward up to 20 years. Next slide, please. How do you go about getting the credit? First, connect and hire a qualified candidate. There are many very good resources to help with this. A good one for Pennsylvania is called PA Career Link. You can see there's a link here in the presentation to get there. This webpage has a database of qualified candidates searching for employment, as well as many other connected services. Second, once you hire a candidate, you file a request for certification with the state workforce agency using Form 8850 that shows the employee falls into a targeted group. As well, some candidates actually already have their certification ahead of time. Third, claim the credit on your business tax return. And you do this in the employer's first year, the employee's first year of employment. Next slide, please. Here are some more resources. These are all links that are included in the presentation. And finally, those are the resources. And now John Campbell is going to discuss new market tax credits.
Great. Thank you, Carrie. And thank you, everyone, for attending today. So as Carrie mentioned, I'm going to start us off with new market tax credits. This is a particular kind of very lucrative incentive tax credit that was started in 2000. And it is effectively credits that are given to people for making investments, but through ownership, so equity investments in what's called community development entities, or CDEs. So these entities are going to be able to be effectively operating businesses, and through the investment made into them, they are hoping to incentivize disenfranchised areas to help build that up. The certifications come from what's called the Community Development Financial Institutions Fund, or CDFI, which is effectively a division of the U.S. Treasury. So it's ultimately the U.S. government is deciding who would be able to qualify for one of these entities. One unusual thing that this does is that the CDE actually is not necessarily needing to have its own direct interest in the operating business, the qualified business. It might also be able to make a loan. So again, it's just ultimately just a matter of trying to get funds to a business that wants to operate in an area, but very unusual that they allow the credits to pass through a loan as opposed to just direct ownership. As I mentioned, the business has to be located in these certain zones. These zones are identified by census tracts. So as those get updated every 10 years, the census tracts are still what ultimately drives whether or not a business is located inside of it will then allow it to qualify. The way that ultimately the credit is going to pass out to the investors is that the CDE is effectively selling it to the tax credit, the tax credits to the investors. So they're basically saying, join us with your equity investment, and in exchange, we will pass out the credit to you. So really wonderful, interesting way of generating capital for investment in these areas. The one big kicker for these for this particular kind of credit is that it's a very competitive process. So even though the U.S. Treasury ends up pumping billions of dollars every year into the tax credit pool, because you have to apply, there's only a handful of businesses that ultimately will end up getting the allocation of that pool of credits to give out to their investors. So so if those of who go through the machinations definitely want to make sure they have everything buttoned up and presented as best they can. The types of businesses that qualify. This is also an unusual situation that there is really no requirement that the business has to be a for-profit entity. So you're often thinking with tax credits that you have to have profit that you're offsetting. And we talked about a couple of examples where nonprofits earlier today that where nonprofits could still potentially be able to receive this credit. And this is an example of one as well, because again, the nonprofit's effectively going to be able to pass that out to the CDE or via the CDE. So that's why if they're the ones receiving the funds, it still would allow you to qualify. So I think that's also another huge boon for this particular kind of credit. In terms of the for-profit or in general, the industries, there really is no specific set industry that is restricted, which is wonderful. However, there are per historical prior year applications, there are certain industries that seem to win out greater than others in overall percentage. In order, those are retail, manufacturing, healthcare, and professional service firms. So just again, for you to keep in mind, it doesn't necessarily mean if you're not on this list that you're not going to get the credit, but historically these industries seem to have gotten the credits over some of the other ones that have applied. The way that the credit works is that you actually get these credit over a period of 7 years. So once you ultimately make the investment, these credits are available to you, similar like with low-income housing, where the credit is available for a period of 10 years once you apply. In this case, it's only 7, but again, it's the idea that once you apply, you can get it and over a larger period of time to recover your benefit. The cap, there is a cap on the dollar amount that you invest to qualify for the tax credit, and so at one point you will have it's not like it's an unlimited pool, even between the credit itself being limited and also your dollars. But again, the big reason that they do this is as a way of trying to get economically distressed communities to build up their businesses, create local jobs, and ultimately just try to create more thriving neighborhoods where they otherwise may not have existed. The other one I'm going to talk about is a little bit more recent, but it's sort of built on the concept of the new market tax credit. A lot of you may have heard about this, and that's the Qualified Opportunity Zones, or QOZs. This was created by the Tax Cuts and Jobs Act of 2017. And again, it's based on census tracts. So it's the same concept that they're looking at areas that are otherwise deemed to be economically distressed, and the way but instead of having like a CDE that you make the investment in, their term is called a QOF, or a Qualified Opportunity Fund. So you would make an investment into this Qualified Opportunity Fund. The fund then makes an investment into a qualifying opportunity zone trade or business. So it's similar kind of concept, qualifying business and CDE. This is now QOF and QOZTB. So the way that it works is that you have to take existing gains that you've had. So you incur a gain that would otherwise be taxable, specifically a capital gain or certain Section 1231 gains that are treated as capital gains on a taxpayer's return. You can cherry pick certain gains that you would want to use. So you don't necessarily have to have a net gain. You can just pick one giant gain if you want to use that. And you effectively say that you defer that gain in exchange for getting the benefit of the Qualified Opportunity Zone. The fund itself, unlike the new market tax credit, instead of having to go through a process where the a division of the U.S. Treasury has to certify you, the fund can actually just certify itself. It just says that it's making a contribution. It's going to make contributions into a qualifying business, and then as a result, they just, by telling the IRS, that makes them a qualifying opportunity fund. So, much lower level of barrier of entry. So compared to the new market tax credit, aside from the fact that you actually need capital gains to directly invest. The funds themselves have to be invested within 180 days of that gain recognition. So that definition can change depending on the source of and the type of gain. So, these rules can get a little bit more complicated, and we're certainly happy to help you if you have a situation where you might want to take advantage of this and aren't sure exactly how this works, but just know that you do have about roughly a 6-month window of time to make the decision whether or not you want to make this investment. The other big piece is that these gains that you're deferring must be recognized as of December 31, 2026, based on the tax rate at the time. So just to tie that into things, the Tax Cuts and Jobs Act had lower tax rates through 2025. So in 2026, the tax brackets go up again back to the pre-18 rates. So depending on the type of gain that you're deferring, you might be subjecting yourself to a higher tax bracket in doing this. And an exception to that would be if you actually sell your interest prior to the date, to this December 31st date, that would force you to recognize the gain at the exact moment that you get out of your qualifying opportunity fund. So keep that in mind. This is not necessarily something if you do this, you might not be kicking the can as long as you were otherwise thinking. And I just want to show this quick slide here for everyone, just to give you an idea of what this looks like. So the purple represents the census tracts that would allow people to have qualifying opportunity zones, trader businesses. As you can see, Philadelphia has a significant amount of census tracts that would qualify. The other side of the river, there's also some pieces in Camden, and even further down on your way towards Wilmington and Wilmington itself, there's also a very significant amount. So just want to show this as a highlight. It's not necessarily saying that these are very rare, but rather they can actually be quite expansive. In talking about the deferred gain, you might think to yourself, well, what's the benefit for me if I'm going to make this investment? Which is an important question to ask. So if you were fortunate enough to have made the investment before 2021, one of the benefits of making this QOZ deferral is that you actually would be able to eliminate 10% of your gain if you hold the interest for at least 5 years before 2026, December 31st, 10% of whatever you defer just is no longer subject to tax. And if you were able to jump on this, hold it for 7 years instead, and again, without having sold the interest, you could actually eliminate 15% of the deferred gain. So again, this is not something that's available in 2022 because you can no longer meet the 5 or 7 year period before you're forced to recognize the gain. But a very big thing to understand is that even if you were to join in after the fact, the taxpayer who holds onto their interest for 10 years gets to recognize no gain on the difference between the deferred gain and the gain on the actual sale of the interest. So if they sell their interest after 10 years of holding it, and they sell their interest for $1 million, and the gain they deferred was 100,000, they don't pay tax on the 900,000. So very, very huge benefit. And again, it's a long-term, the idea behind this, it's a long-term benefit. So they're trying to incentivize long-term growth, long-term investment, but they're willing to say that if you make the investment the right way, it can save you quite significant amount of tax dollars. Another kind of similar incentive, not necessarily credit, is something called the Keystone Opportunity Zones. This is something specific to Pennsylvania. That was established back in 1999, so just before the new market tax credit came about. This has been expanded on a couple of occasions, and the last time it had been expanded was in 2017. So it's not something that has been coming up as of recently, but it is still something that's around because it allows people to have certain deferrals or exclusion of income from taxation for Pennsylvania purposes, and it can also benefit at the local level as well. You're able to, again, there's various types of taxes, but the most common ones that you might be excluded from are corporate net income, personal income tax, and sales and use tax for items used within the Keystone Opportunity Zone. So another one interesting boon that you might be able to, especially in this day and age with sales tax becoming a little bit more prevalent with the Wayfair case from 2019. And then on the local level, it also allows you to exclude property taxes, so you can avoid paying property taxes if you're in the Keystone Opportunity Zone. This is something that has to be renewed every year with the state or the city. And again, it's even though they're not necessarily setting newer zones, these zones exist. And if you are in one or move into one, you might still be able to reap the benefits for the next few years of just effectively excluding your gains for Philadelphia, for PA, and especially Philadelphia with their tax rates are even worse than Pennsylvania. Again, a very huge benefit overall. So that I'll give you back to Jeff to close this out. Thank you, everyone.
Great, thank you very much. As a reminder, I think we're getting close to the end, so we want to be mindful of everybody's time. So we will take your questions in the Q&A box. If you have any additional questions, feel free to add them to the Q&A box. We will get back to you as soon as we can regarding some of your questions. Keep in mind that the slides would be available for you if you want them. And also the video of our presentation today will be on our YouTube channel and also on our website. So I wanted to thank you again for your time, and thank you to the presenters. Everyone did a great job today, and have a nice holiday weekend. Thank you very much.